Hi folks, if you are asking whether it is best to invest in gold or invest in stocks, the best way to answer this question is by looking at a ratio chart. Now, today we are looking at a ratio chart between the Dow Jones and the price of gold, and we will do this on a weekly scale. Okay, this is for medium to long-term horizons, time horizons, but if you are more like a swing trader hopping from in and out from one market to the other, then perhaps you want to do the same exercise on a lower time frame, right? But it's essentially the same. The ratio chart shows which market is outperforming or which market is underperforming the other in a pure objective way. We are translating one chart in terms of another, or in other words, we are pricing one market in terms of another. And in this case, we are pricing the stock market, the Dow Jones, in terms of the price of gold. This is a weekly scale of the ratio chart. Interestingly, we see here a low in January 1980. This was the historical moment where both markets were trading at par. At that time, more or less, both markets were quoted more or less on the $800. We had a massive gold rally here in the late 70s. Bringing gold up to the 800 and something handle here, and at that very same time, the Dow Jones, we can see it here barely here on a arithmetic chart, but we had the Dow Jones also trading here at the 800s thereabouts. Okay, from this point on, then we have this massive rally that accelerated here towards the mid-90s into the tops of the dot-com bubble here in 2000, January 2000. And in gold, it more or less corresponded to the bottom. So this was this whole 2 decades long period, which corresponds to this rising here in the ratio, correspond to this outperforming of stocks. Or in a ratio chart, if the ratio is going up, means the market that you have as a base on the pair on the left side of the equation, this market is outperforming. It doesn't necessarily mean that when the ratio is rising that one market is that the base market is rallying and the quote market is falling. Both markets can be rallying. For instance, if you have a situation where the bond market is outperforming stocks and commodities, you can have commodities and stocks falling, for example. But if stocks fall further than gold, then gold would outperform stocks, even if both are falling. And the ratio, in this case, the ratio would fall because stocks are underperforming gold, right? But both would be falling. So the ratio chart doesn't give us direct clues about the directionality of the market, but it gives us very interesting clues about the capital allocation and the strength of that market in terms of another. And it really answers the question, where should I put my money if in one market or the other? Do simply a ratio. You can do ratios with any market. Okay, so then we have, after this peak in 2000, we have the lows here in September 2011. This corresponds to a peak in the price of gold, above the almost touching the $2,000 mark, and then from then on we have a period where stocks outperformed gold, but not as impressively as it did in the late 90s, right? Overall, we can say that until today, from that low in 2011, we can see that stocks outperformed gold, but this was not entirely true for the whole of this period. We have a period here since the tops in 2018 to the bottom here in March 2020, where gold really outperformed. This corresponds here to this bumpy period that you see here as an expanding pattern here on the Dow, with a serious crash here in the beginning of 2019, and a more serious one in the first quarter of 2020. The lockdown-induced crash, and this whole period from 2018 till the bottom here in 2020 on the ratio, so shows like the ratio going down means gold was outperforming. If you look at the chart of gold and look at this period here, late 2018. There was a bottom here in September, and then we have this huge rally until August 2020, where gold peaked above the $2,000, and then it peaked again in March 2021 last year. And in March last year, this was when we had the second peak here. Let me check here, 2021. Yeah, we had almost here. We were breaking here above this descending line on the ratio, means that at that time stocks were already on the rise again and outperforming gold. It was not until September, more or less August, September last year, where stocks underperformed for a brief period, and right now. And here is where we come to answering the question is, where right now is it best to invest in one market or the other? Well, in my view, stocks are still continuing to outperform gold, and we are about to break this descending line from the highs here in August 21. We are about to break this descending resistance. Everything looks like we are going to reach for this 22.5 in the ratio, corresponding to the highs here in October 2018 in the ratio. So there is a considerably gap here to the upside, where stocks could continue outperforming gold. It doesn't necessarily mean that stocks could be on the rise, but it could be also mean that gold, and together with other commodities, would fall further, even if stocks stayed equal. As now, we would see the ratio rise. In any case, as for capital allocation issues, it is more interesting right now to have capital in, or a bigger allocation in stocks than in gold. This breakout here would be an interesting dynamics, because we already saw a breakout here in 2017, a break above this descending line from the all-time highs here in the ratio, and then the subsequent price action, although it took a lot of a couple of years to perform, but we saw here the ratio rally for a while. Then we have a pullback here in mid or more or less with the March 2020 lows, and then we had a subsequent breakout of the new descending line, corresponding to this peak here in September 2018, and then a pullback again to that same line used here as support. So we have this change of polarity in being overcoming a resistance, and then using that resistance as support later on for a pullback. We had the same micro dynamics here on a smaller scale happening this year. So all implies that we're going to see a new breakout, and then eventually we will see spring next year as the point of pullback, because again we are having an intersection here for May 2023, and as if you remember other videos that we're looking at, we are getting a lot of intersections or a lot of markets that are pointing to key intersections in spring next year. So it looks like spring next year is going to give us some clear directional market. So we could see this breakout happening now for a while, stocks outperforming, and then pull back to spring next year and continuation to the upside. This would be one potential scenario, the one that sees more likely because of the technical situation alone. Okay, I'm not entering here now into the macro side of things, but on the other side, if we consider the bearish scenario, then we will have to take into account this ascending line, this support, the green line, where we just reacted to a couple of weeks back. This line, if we follow this line all the way back here, it takes us to the lows of 2009, the crash, 2009 crash, and the ratio here is not an absolute low. We see the low, the absolute low here in September 2011, because gold kept outperforming stocks, so it printed a lower low here in the ratio, but this low here corresponds to the low of the 2008 crash. So this line becomes important from its significance. It's not that this line will change anything big here on the ratio chart. A break of this line wouldn't imply a lot of changes in the ratio. We are still trading above this strong support, but the implications, because this line corresponds to the low of 2009, immediately as technicians we would start looking at the underlying charts as to what lines can we trace back to 2009, and dynamic lines especially, in order to get a more clear target how far the potential correction in stocks could go. Okay, this would be the first signal. If we lose this line here, this support that right now is coincident with this ascending blue line from the March 2020 lows, which in itself is also a remarkable low. Okay, if we lose both these lines, then we are immediately, the market is thinking about recapturing any levels that correspond to these bear market scenarios, 2020 and 2009. Okay, so immediately we set an alarm here. As soon as we see the ratio dropping between these lines, then the gap from this green and the blue line towards this green support here is less than 5 points on the ratio. And from here, once we bump against this line, look at the price action. Although we pointed out this dynamic before, where we see this zigzag here and this subsequent zigzag here as pointing to potential a continuation to the upside. Okay, although we have these positive dynamics here, a unwinding of this price action and a bump here against this support would invalidate here the last breakout and pullback action here that we saw. It would invalidate it immediately, and would open the doors for this scenario here, encapsulated in these green areas. And notice also that this zigzag price action here, it's staged a lower high here in August 2021 than in 2018. So we could see eventually then, if we had a lower high here than here, and eventually the market is telling us that this time, if it loses these levels and it reaches this green line here, it's going to reach a lower low than in March 2020. Then we have to look at any line in the chart of the Dow that corresponds to the 2020 crash in order to have some clear target there. Okay, so just to finish here, there are two more lines here. These gray lines that I'm going to bold a little bit here on the chart for you to see. I didn't want to clutter the chart with too many lines, but I wanted some confirmation that this level, the 1 point something level intersecting here in August 2027 can be confirmed with any other dynamic line. And well, we do have a line here that is not very significant from where the line goes through, but it's a parallel line from this one. We have one line that is sitting here on the 2020 low. So eventually this line could see some increase in significance if the market starts to travel this lower path. But we are still far from it. We would need to first to see losing these supports. Right now, as I said, my stance here is for an upside continuation. That is an outperformance in the price of stocks. Paying attention to spring 2023 for more directional clues, since we are getting this intersection in many other markets. Okay, that's all I got for you today. I hope you liked the video. Subscribe to the channel if you want to receive more alerts. We are going to look at more ratios between other markets in future videos. For today, that's all I got. Thanks for watching. Bye.